Hello everyone, this is GK Chow here at CKC Lending, and in this video I will be explaining how bridging loans work, when they make sense, and how they can help you buy your next property before you sell. Let's dive right in. Here's a challenge for homeowners who are looking to buy the next property. Let's say you found the right next property, but your current home hasn't even sold yet. The seller wants a quick settlement, and you risk missing out. Selling first may mean that renting out temporarily. You might even have to move twice, which is quite stressful, time consuming, and it can be expensive. So, what are the options that we actually have? Let's talk about a bridging loan. A bridging loan is a short term loan that allows you to purchase your next property before you sell your existing one. It bridges the gap between buying and selling. So, instead of timing poor decisions, the structure gives you flexibility. You temporarily hold both properties while the lender structures a combined loan position using your equity. So why do people use bridging loans? There are three good reasons people use bridging finance. First, flexibility to buy first. You can secure the right property without having to wait for your current one to sell. Secondly, you avoid renting. You move directly from one home to another. Third, selling without any pressure. You're not forced into accepting a lower offer just to meet settlement deadlines. It gives you a bit of breathing room. How a bridging loan works. During the bridging period, you temporarily hold two properties, the existing home loan and the new loan to finance the purchase price and the associated cost. Now, this is what we call the peak debt, the highest total loan during the bridging phase. Once your original home sells, the sale proceeds are used to reduce the bridging loan, with the remaining being your end debt. The key point is this. It is really the equity in your own home that is doing the heavy lifting during this transition period. The bridging journey can be thought of as three stages. Stage number one, your existing home. There you have built up equity. Stage two is the bridging period. You temporarily own two properties, as well as the loan increased to cover both. Stage three, your new home. Once your original property sells, the loan reduces to the final loan term position. Temporary increase, then reduction. Structuring a bridging loan is very important because every bridging loan must be tailored, as no two bridging loans are identical. Property values, existing loan balances, income, timing, and even your personal comfort during the transition all have an influence of the structure. Your circumstances will ultimately determine the best approach, and that's why professional structuring is important. Now, choosing the right lender is also very important because not all lenders treat bridging loans the same. Some assess risk very differently. Some allow interest to be capitalized, whereas some apply stricter servicing rules. The lender choice can determine the approval as well as the overall success. So it's not really just about the interest. Again, it's really about the structure. Now, let's look at a case study. Meet Ronnie and Connie. Their existing home is valued currently at $1.2 million. They have $600,000 owing against it, and they've got $120,000 in savings. Now, they're looking to purchase their new property, which is worth $1.3 million, and the transaction costs such as stamp duty, legal fees, and other expenses is roughly $60,000. When you look at the existing lending position, you'll notice that the property value is $1.2 million, and because they owe $600,000 against that home, their starting loan to value ratio is 50%. Now, this shows a very healthy equity position. To work out the total funds that they require, we first look at the purchase price, which is $1.3 million. We add the purchasing transaction cost of $60,000. Because they have $600,000 owing, the total funds that we need to complete this bridging gap purchase is $1,860,000. Let's look at the bridging loan position. Most lenders will cap the bridging loans at around 85% of the existing property's value. If their current home is worth $1.2 million, 85% will allow them to borrow up to $1,020,000. That becomes the bridging loan component. The remaining amount forms the end debt loan. This is the structured position during the transition. All right, next we will move on to the end debt loan. What is the end debt loan structure? The total funds that they need to purchase the new property as well as paying out the existing loan is $1,860,000. Again, if the maximum bridging loan component is 85% of their existing home, that's $1,020,000, which means there is an end debt of $840,000 left over. Now, this is the amount that they require to secure both properties during the bridging period. But remember, this will reduce once the existing home has been sold. So when Ronnie and Connie sell their existing property for $1.2 million, the bridging loan of $1,020,000 is immediately cleared. That will now leave $180,000 in remaining proceeds. Those proceeds are then used to reduce the end debt loan. The final loan balance reduces from $840,000 to $660,000. This is the long-term mortgage secured against the new home only, and the bridging loan has now been finalized. When considering bridging loans, there are very important considerations. Now, although they provide flexibility, that does come with a cost. Interest accrues on the total loan during the bridging period, so the longer the property stays on the market, the more interest you will essentially pay. Pricing strategy does matter, so the realistic timeframes will reduce stress as well as their holding costs. That's why expert structuring ensures flexibility is balanced with cost management. So now that you know about bridging loans, you can tell that they're very powerful when structured properly. Although they're not suitable for everyone, in the right situation, they do provide control, certainty, as well as flexibility. The key is understanding the numbers and having the right structure in place before you commit to purchase your next property. Now, I hope this video was helpful, and it would be really appreciated if you could like and subscribe. Your support will help us create more videos like this to help more Australians learn about the lending market. Thanks again for watching, and I'll see you again at the next video.